Hi there, everyone, and welcome into this week's market update. Don't forget that any advice contained within this presentation is general only, so it isn't tailored to your particular circumstances. You need to decide for yourself whether it's appropriate to you. Alrighty, so in front of us here, I've got the chart of the XJO at this point of time. We're stuck back inside a triangle pattern, as you can see there. It's been a pretty wild few weeks on the market overall. Once again, we're down quite a bit from our all-time high. So from the highs to the lows, we're roughly 9%, which really is nothing compared to what we're seeing in the US markets at the moment. But, still pretty harsh fall in a very short period of time. Our market's holding fairly well, though. You'd still sort of comment to say that we're in an overall channeling pattern. You can see you got three peaks across the top here at the exact same level, three troughs along the bottom here at almost the same level, maybe 4 or 5 actually along that level. So look, the 69 level is pretty key for us. If we continue to hold that, I'd be calling this really more of a channel than anything. But nonetheless, that's medium term. Short term, we are on a downtrend. Lower peaks, lower troughs through here. We're up, testing that downtrend line, and just waiting to see whether it's going to break through, push back up a little bit, or hold and come back down to around 7,000 or 6,900. So we're a little bit in limbo again, once again here, guys, of which way is this market going to break. All right. I suspect we're going to hang sideways down here, even for a few months potentially. Okay. And I'll talk to that reasons why in a moment, but let's get the technicals out of the way first. So S&P 500, that's looking a fair bit more bearish than what our market is. Okay. Doesn't matter how you spin this now. For me, looking at the weekly chart, that is clear as day, a head and shoulders pattern. That head and shoulders pattern has now broken, which is confirming for me a move back towards 3,500, which is the 200-day moving average, or 200-week moving average, I should say, since we're on a weekly chart right now. Every bit of technical I use is suggesting 3,500 as a support level, okay, or 3,600 thereabouts. Use your Fibonacci retracements. It's suggesting a move back towards there as well as on the table. So, look, we may not have seen the worst of the selling just yet, guys. Okay, technically, a lot of things are suggesting 3,600, and for me, only way that doesn't play out is if we start getting some good news around inflation or interest rates. Okay, so something will need to change the current sentiment in the market for this not to play out. Otherwise, that's the technical signals that we're seeing right now. The Nasdaq, look, similar sort of situation, right? This is once again a weekly chart. You can see the head and shoulders there. That head and shoulders has broken. Not much else to say, guys, but that looks like a bear market to me, right? So for me, look, Nasdaq clear bear market, S&P 500. Not 100% confirmed, but looking like a bear market as well. But the XJO not quite in bear market territory at this point of time. Okay, still in sideways territory. So our market has split and it's changed a little bit, right? Usually we are in the exact same trend or exact same pattern as the S&P 500. Right now, it's two different patterns. We're in a sideways pattern on the XJO, but the US S&P 500 is looking more bearish at this point of time. Okay, so there's a bit of a change going on here. And one of the reasons for that, guys, is that we are more of a value-based market. We're more of a mining financial market. And at the moment, with commodities behaving the way they are, we should be holding a bit stronger than the US market. Our economy should be holding a bit stronger than the US economy at this point of time. So essentially, what we're seeing at the moment is a huge sell down in growth. Value is also selling, but nowhere near as much. Okay, so what's the difference? A growth stock is a stock that perhaps isn't making much profit just yet, but is increasing revenues by 50, 30, 100% a year. Okay, so it's often a younger business, okay, that's still in that growth phase, right? So that's your typical definition of a growth stock. Value stocks, usually a higher dividend stock, a company that maybe is only growing 5 to 10% a year, but it has been around for a while, proven concept, proven business, sort of a staple type business that you know that you're going to be able to rely on in the long run, likely isn't going anywhere, well managed. That's your kind of value stock. It's already trading at a value price, right? It's past that growth phase. Okay, so think your BHPs, your CBAs of the world. That those types of stocks you classify as value stocks at this point. Okay, so our market has outperformed the US market over the last 12 months. Okay, rare to see that. Okay, but if you zoom out and you look at the market over the last 3 years, the US has still very much outperformed us. Okay, so what's happening here, guys, is the US was way overdue for a massive correction. They had a huge rise after COVID, and this is the correction phase. Okay, and growth is getting hit the worst. Even over the last couple of weeks, value stocks have fallen, but growth has been walloped in comparison. Okay, so value is still the place to be. Up until we see a change in the sentiment towards interest rates. At this point of time, the sentiment out there, guys, is that the US Fed is gonna front load. What that means at this point, what we believe it means is the next two rate announcements, one in June, one in July, are both going to be 0.5% increases. Okay. Then on top of that, guys, we're expecting them to continue to increase rates at every single meeting for the rest of the year. Well, at least that's what the bond market's telling us. That's what the big analysts are telling us. That's what they believe is going to play out. So as long as that's the view, I am struggling to see how this market is going to have any prolonged buying in that growth space. Okay, until the sentiment towards interest rates changes. Now, what's going to change that sentiment towards interest rates? Well, it's going to be inflation. As long as people believe inflation is going to keep increasing, which was what the message we got last week from the Bank of England, from the Fed, that inflation is not quite under control yet. Until this shifts, until something here changes, this dynamic, we can't see really the Fed changing their rhetoric too much. Okay, so we need a sustained view that inflation's topped and coming back down again. And that's where you'll see a massive shift in the mood of the market. Okay, that's where growth will start performing really well. There's a few different types of ETFs you can do, especially in the Australian market, that will give you access to the growth side of things. Okay, there's diversified growth ETFs and things like that that you can look at when this plays out. I'm not seeing that yet, guys. Okay, it could be weeks, months, 6 months away. How do you predict it? Okay, there's such a complex issue at the moment between the Ukraine-Russian war, between China lockdowns, between COVID disruptions that's hurt the complete supply chain. It's going to take a while to clear this up. So what's the central banks doing in the meantime? We got supply chain restraints, we got supply chain disruptions. So to bring this inflation down, they're attacking demand. So what happens when you attack demand, guys? You soften the economy. So there's now that talk of, is the US going to go for a soft or a hard landing? Okay. And this is the problem. This is why I can't see markets going up much from here. Yes, they're oversold. Yes, they'll go up in the short term, but I can't see it being sustained like what we saw, that nice big 10%, 15% retracement we saw 6-7 weeks ago. So at this point in time, guys, I'm sideways to maybe a bit bearish, right? And just keeping my eyes peeled every day on any news around inflation, any Fed meetings, or any of the Fed members talking, right? We want to sense that change of sentiment towards inflation, that change of sentiment towards interest rates. That's your buying opportunity, right? Now, that's for the US market. For our market locally, what I'm really looking at right now, short term, is commodities pricing. So iron ore, copper. Copper got hit pretty hard over the last few weeks, and that's one of the reasons why we followed this time. Okay, we fell down quite hard, didn't we? Right, we did a 10% correction almost. The S&P 500 also almost did 10% in that 2-week period. So that's because copper fell, iron ore fell. And what was a lot of that on the back of? Okay, on the back of China lockdowns. Okay, but what we're starting to hear now is that they're slowly coming out. So Shanghai's slowly coming out. Beijing's not in complete lockdown. So we're starting to hear a little bit more positive news around China at the moment. And that's why I believe the commodities markets were up overnight. But looking at the charts of things like copper, iron ore, they're still on their downtrend lines. We still do not have confirmation of that break to the upside yet. We might get that tonight, but that's what I'm looking for. If we can get that sustained buying in the industrial metals, so copper and aluminium, just to name those two, they're the main two I like to look at. Silver, gold is probably more towards an inflation trade than anything. But for me, iron ore, copper, aluminium, those three are the main ones that I like to look at to trade stocks like BHP, Fortescue, Rio, S32, Oz Minerals, five of the major material stocks in Australia, which are screaming for a trade, guys, because they're so oversold. It's just now for me about, well, where's that bullish entry signal? And that's what we're looking for right now. So miners are definitely at the top of the list of stocks to be looking at in the short term here, guys. They're heavily oversold, but it's going to come down to how commodities markets behave. The other thing is crude. Crude jumped to 114 US dollars a barrel last night. Highest it's been in a while. It got as high as 120 on the back of the Ukraine-Russia war in February. And if that keeps going, well, you might have an opportunity in the energy space because that's another favored sector at the moment. The US energy sector has gone up a lot more than what ours has recently. So there could be an opportunity in stocks like Karoon and that's just KAR is the code of that, or Santos. So there's a few opportunities there coming soon, I think, in these spaces, guys. So just waiting for those entry signals to confirm these views. All right. So if China lockdowns continue to relax, okay, if they relax these lockdowns, if that's the theme, that's what we see over the next few weeks to month, then short-term trades are definitely going to be looking pretty keen on materials and energy stocks, commodity stocks, that sort of thing. Okay. All right. So China lockdown is important, inflation, okay, and obviously anything around interest rates. That's what the markets are really looking at for me at the moment, what we're looking at to try and pick the market right now. So the next big thing, obviously, which is at this stage not too big for our market, guys, is the Australian election this weekend. I don't think it really matters who gets in power, okay, at this point of time. I think both of them are put forward a bit of a spending agenda. So it's a bit more of a stimulus type budget. Okay, they're spending, they're putting money into the economy, not taking it out. So that's going to be perceived fairly well neutral to positive for the market regardless. So last election is definitely the market did not want Labor to get in for obvious reasons. Okay, franking credits, negative gearing, things like that. It's going to affect the investment landscape. So the market did not like the idea of Labor getting in. Rallied pretty hard once the Libs got it. So this time around, I don't think it matters, guys. For the markets, just doesn't matter at all this time around, I believe. Okay, so Aus election this weekend. Both look like spending agendas are on the table to keep stimulating the economy after COVID. We know there's heaps of infrastructure spending coming down the pike, and that's just going to take time to come through, right? Okay, so look, I think overall short to medium, especially the next 2 months, knowing there's another two large interest rate hikes out of the Fed, that hanging over the market's head, I can't see a huge amount of bullishness unless something changes that mood. I'd be more bearish to sideways on the back of that. At some point, the market will price in those rate hikes. Yeah, at some point, the market will just get over it and will stop selling on the back of it. But I can't see the sustained buying, knowing that that's hanging over our heads, and that's the mood right now. All right, so that's the piece that needs to change for me to really commit to bullish longer term. But I have to say, once interest rates top out and we do get inflation under control, I would be very, very bullish for the equity market, guys. I think there's a lot of cash on the sidelines that have come out of crypto, come out of the market, come out of bonds. There's a lot of cash there ready to be invested. And as soon as the confidence levels come up that interest rates have topped and are going to turn back down, I think that's your switching point across where they'll start going from, they'll start stimulating again. If the supply chain's cleared up, they'll start stimulating again and get the economy booming. That's what they're after. But they've got to do it at the right time. So for us, that also means we've got to invest in the market at the right time. So still at the moment, what am I doing? I'm looking at things like miners in the short term because I think they're still positive. Okay. Um, I think demand for copper and especially anything around the green energy space, future metals, that sort of stuff's going to be still in high demand. I think that they should hold well or lift from here. But staying away from that growth space completely, discretionary, communication services, technology, staying away from that space completely until we start seeing that turning point in interest rates. And that's where we start switching back towards growth. Okay, and start gearing back up on growth a bit more. But keep some powder dry for that, guys. Honestly, there was going to be a huge opportunity later this year or early next year in the growth space. So just keep an eye on it. Things can change on a dime at the moment. We can be talking very differently in a week or in a month's time. So this is where keep some powder dry, wait for that shift in sentiment, and that's where we know we can jump back in on that space. Okay. All right. So that's enough from me, guys. All right. Thanks for listening into this video today. Take care and bye for now.